Welcome to Law Easy. My name is Marty Schenkman. I'm joined for this video clip by insurance consultant Richard Harris, and we're going to talk about life insurance and scuba diving, specifically underwater insurance policies. That's about as best as I can do on insurance humor.
Okay.
Richard, why don't you explain what an underwater policy is? Ignore my terrible attempt at humor, and let's talk about some of the issues.
An underwater policy can be one or both of two things. One, it is a policy where it's likely to lapse at the current funding level before you die.
I'm going to interrupt and interject, and I know I use this in another video clip, but it kind of shocked me when I heard the statistic, and everybody's got to focus on this. Something like half of the life insurance policies owned in irrevocable life insurance trusts, the way they're structured, will lapse before life expectancy. Is that reasonably accurate?
Yes, and there's one point I want to make about life expectancy that people don't appreciate. Life expectancy actuarially is when 50% of the people that took out insurance when you took it out at your age in the same health as you are expected to have died. That also means that 50% of those people are going to be alive.
Which is not good for the insurance policies that are underfunded.
Exactly. And
keep in mind there's a significant correlation between wealth and education and life expectancy. There was a study I saw a couple of years ago that looked at life expectancy of people owning a $1 million term policy. So in many cases, permanent insurance inside of a trust could be much greater, but there was a significant bump in life expectancy of those buying $1 million policies. In other words, the wealthier, more sophisticated people tend to have a bias towards longer life. So the underwater issue Richard's talking about is a major concern. Sorry to interrupt. You had to talk about point two as well.
Okay. Point two is either because of borrowing or because of the performance of the cash value. The value of the policy is less than the amount of money that you put into it. You expected it to be more at a certain point, and that didn't happen. So, in effect, if it were an investment, you would have a loss. But because it's an insurance policy, you can't take that loss. However, there is something that you can do about that. You're able to exchange an insurance policy on a tax-free basis, keeping the same basis, into another life insurance policy, or you can exchange it into an annuity. And the annuity will have the same basis as the life insurance policy has.
That's the so-called 1035 exchange?
Yes.
For those that get excited by code sections?
Right, like a 1031 exchange for real estate, where you don't pay any taxes, even if you have a gain. Well, there's no gain here. But the point here is, later on, you might be able to surrender the annuity, and because the annuity is considered an investment for tax purposes, you may be able to take a loss based on your basis that goes back to the life insurance policy. So you might be able to turn that into a tax benefit for you.
What about reevaluating a policy, and if the policy itself could be good, can you fund it additionally in order to keep it in force, to get it out of being underwater?
That's another option. It depends what you want to do with it. There are really two things. One, funding the policy, and I'll get into replacing the policy very briefly. And the other is, depending on your circumstances, if you don't really want the policy, you may be able to sell it and get more than the cash value from
secondary market.
The secondary market.
So underwater policy, first step, evaluate. Look at your goals and objectives. You may be able to 1035 into a new policy or an annuity. The annuity option may give you a tax benny. You may be able to reevaluate how you're funding it and change the funding, or sell it into a secondary market.
You've now gotten insurance 102.
102. Any other thoughts or strategies on underfunded life insurance?
Well, in some cases, you may have a policy that has a loan. And you can 1035 policies into new policies. However, if the loan and the cash value is more than your basis, if you just 1035 the policy into a new policy without the loan, you're going to have a taxable event at that point on what they call the boot. However, there are certain companies that will allow you to transfer the loan with the life insurance policy so that there is no boot. And it may be advantageous, depending on the underwriting that you can get with the company and the product that they have that does that, may be advantageous for you to do that rather than try to rescue the one that you have.
Let me ask you another question. We've just talked generally about the issues of underwater policies and some of what could be done. What if this policy is in an insurance trust and you are the trustee and you have a fiduciary responsibility to the beneficiaries? Anything you would do differently, but maybe even want to just make some cautionary comments about that issue in general?
Well, just as a warning to trustees of life insurance trusts, that you are a fiduciary, as you said. I do expert witness work, and I had to defend a trustee of a life insurance trust. The trustee should be in contact with the beneficiaries and going over with them the options so that they have that we just went through, so that they have that. I just did this with an attorney where I went through all the options with them. With him, he's the trustee, and then we went over it with the beneficiaries for them to decide what they thought would be the most appropriate course of action.
For some reason, when people establish life insurance trust-owned insurance, which is a great part of planning, it's a core of many, many plans, there's this incredibly dangerous, foolish misconception, gee, Uncle Joe asked me to be a trustee, I'm helping out family. Family doesn't sue? That actually is not true. Family will sue. And if you don't take the job seriously and you don't document the process that you're going through to manage the insurance policies, and there's several video clips we've done that talk about that, you could have a problem. If you do identify a problem, and you should identify issues every year with an insurance review if you're a trustee, or certainly every other year, and you have these options, Richard's point of making sure you're communicating with everybody affected, the beneficiaries, could be vital. But keep in mind, when you're just doing this for yourself, it's perhaps less complex and problematic than when you're in a fiduciary role of trustee of an insurance trust. Any last comments, warnings to make sure people get the message?
I think you just delivered the message.
Okay. Thank you for joining us. Remember that the video clips are for educational purposes only. Talk to advisors before proceeding. Thank you.